Hello everyone, we've come to the end of the second quarter of 2023, which has lived up to all expectations as we look back at the first half of the year. From rising global interest rates, concerns about a global recession, the US dollar reaching parity against the euro, a potential banking crisis, the attention-grabbing developments around artificial intelligence and ChatGPT, as well as the continued war in Ukraine on the global front, to continued load shedding, a grey listing, the Lady R debacle, and a record low for the rand on the local front. From a macroeconomic perspective, the latest outlook of the International Monetary Fund still suggests growth of approximately 2.8% for 2023, led by emerging markets. In the developed world, the US economy remains strong and recorded annualized growth of 2% for the quarter on the back of a strong jobs market and rising wages, which keeps driving consumer spending. In the emerging market space, the Chinese economy is recovering at a slower pace than expected, which suggests that more stimulus will be applied by the government. Inflation rates have continued to decline in the developed world after reaching a peak in the third quarter of 2022. This came as a result of a recovery in supply chains, lower energy and commodity prices, as well as base effects in terms of food prices. However, core inflation remains sticky in most economies, and inflation rates are still significantly above the 2% target rate of the US, the UK, and the Eurozone. This requires the major central banks to continue applying a balanced approach in their efforts to achieve price stability and bring inflation under control while avoiding a negative impact on economic growth. The most recent views expressed by major central banks suggest a few more potential rate hikes may be required before we reach the peak of the current interest rate cycle. Geopolitical tensions were a key feature of the global landscape in the first half of 2023, but had a limited impact on global equity markets as corporate earnings remained strong. Global equity market, as measured by the MSCI World Index, had a very strong start during January, and after a brief pullback towards the end of the first quarter, it rose strongly during the second quarter to close the first half of the year, up 15% in dollar terms. While the global equity market growth was more broad-based during January, a handful of technology stocks drove the market for most of the first half of 2023. The artificial intelligence-fueled growth in technology stocks resulted in the tech-heavy Nasdaq index in the US rising close to 40% in US dollar terms for the year to date. Global bond market yields remained at elevated levels but have the potential to recover on the back of declining global inflation and with the end of the central bank rate hike cycle in sight.
On the local front, the South African economy escaped a technical recession by recording quarter-on-quarter growth of 0.4% for quarter one after declining by 1.1% in the final quarter of 2022. This brought the output level of the local economy on par with the output level recorded in the final quarter of 2019, just before the onset of the COVID pandemic. The positive growth number was recorded despite record low levels of load shedding experienced during the first 3 months of 2023 and points towards the strong services industry element of the local economy. CPI inflation continued to decline during the first half of 2023 on the back of lower fuel prices and base effects, but remained above the 3 to 6% target range of the South African Reserve Bank. Core inflation remained sticky, and this, together with the weaker rand, compelled the South African Reserve Bank to continue raising interest rates during the first half of the year. Declining inflation and high interest rates led to investors in the money market earning real returns for the first time in nearly 2 years. During the first half of 2023, the rand got caught in the perfect storm with load shedding, the grey listing of South Africa by the FATF, rising global interest rates, reduced emerging market risk appetite, and geopolitical and trade-related concerns about the government's stance on Russia. Having started the year at 17 Rand to the US dollar, the rand weakened to an all-time low of 19 Rand 91 to the US dollar on 1 June. During June, the rand was able to recover from its worst levels to close the quarter out at 18 Rand 85 to the US dollar, weakening by 10% to the dollar during the first half of the year. Investors in the local equity market experienced a roller coaster ride as the JSE reached a new record high and breached the 80,000 level towards the end of January, but succumbed to a combination of global and local sentiment and risk aversion to sell off during March and June. A late recovery in June saw the JSE ending the first half of 2023 up by 4%. The sectors on the JSE showed wide dispersion, with the industrial index rising by 16% during the first half of 2023, while the resources sector declined by 13% during the same period. The first half of 2023 was truly a sector selection and stock pickers market. The local bond market suffered with the rand as it sold off to the end of May on the back of negative sentiment and increased inflation, political and fiscal risk perceptions. This led to significant disinvestments by foreign investors during May, after which the bond market recovered strongly during June to record a return of 2% for the year to date. Local property was the worst performing local asset class, declining by 4% during the first 6 months of 2023.
From a regulatory perspective, the allowance to invest up to 45% in infrastructure from the start of this year, as per Regulation 28, enables retirement funds to become part of the solution to address the infrastructure development needs of the South African economy. Finally, National Treasury once again confirmed its intention to implement the two-part or two-component retirement system on 1st April 2024, which we do not believe is attainable given the preparation that is still required by SARS, retirement funds, and 13B administrators. The industry has been provided with a second opportunity by National Treasury to provide comments on the proposed legislation.
When looking ahead to what the remainder of 2023 may deliver, the risk of a global recession has somewhat diminished. All eyes will be on how fast global inflation continues to decline, when central banks will start reducing interest rates, and locally, how fast the energy crisis is being addressed by the various stakeholders. Some areas of the investment market look expensive, given the recent strong performance and the outlook for company earnings. However, some real opportunities exist in the local equity and bond markets. The rand still has some room to recover, barring any political missteps by government, a return to high levels of load shedding, or a risk-off environment caused by global developments.